Regularly, we sit down with Mervin Jebaraj, economist and director of the Center for Business and Economic Research at the University of Arkansas Walton College of Business. We talk a lot about the impact the trade wars with China are having on the U.S. economy through agriculture, trade, and foreign investment. Today, we look at how China is being impacted, if at all. Well, Mervin, what's really happening in China? Lots of crossfire in what we read, that the Chinese economy is being pummeled because of the U.S. tariff war there. What do the numbers actually tell us?
So I think if you were to read just some headlines, you might get that notion that the Chinese economy is being pummeled by the current trade wars. But if you take a longer term view, you'd see that the Chinese economy has been on a downward trajectory. It's been growing slowly since about 2010. That was the last peak growth rate they've had. And since then, the annual growth rate in China has tended to go down. And that was expected by everybody around the world since it started happening in 2010, because the Chinese economy used to grow at 10, 12% year over year, and that is a rate that cannot be sustained by a maturing economy. As the economy matures, it tends to grow more slowly, and you tend to have growth rates like you see in more developed economies. So China's not quite there yet to be a developed economy, looking at 2 to 3% growth on average. They're still maturing, but they're a lot more mature than where they used to be 10, 20, and 30 years ago, when the Chinese economy first, was a full participant in the global economy and were growing in double-digit rates. So, yes, this is the slowest growth they've recorded since about early 1990s, but that downward trajectory started in 2010. It didn't start this year, it didn't start last year, and it didn't start the year before. So the trade wars have slowed the Chinese economy down, but that's not the reason why you see these headlines for the Chinese economy slowing. That's just, where the trend has taken them over a long period of time. So the Chinese economy has some long-term growth issues outside of the trade war and the short-term impact that it's having right now. Some of that has to do with the debt load of the companies in China and local governments in China. And the other major important factor in China is that their workforce is aging. And some of the hangover effects of the one-child policy that they've had in place for many years means that there isn't a lot of young people coming in to replace that workforce. So that means over the long term, over the next several years, China is going to have a much bigger problem replacing their labor force than they do right now. And I think that is a much larger an important concern for the Chinese economy than what's going on with the trade wars right now.
But are the trade wars having any impact on China? Can you see an acceleration or anything in the Chinese economy from the tariffs?
I think if you looked at the trend line of Chinese economic growth, it's been pointing down since 2010, and it's hard to say that there has been any large acceleration that happened since the trade war began last year in 2018. So it's very hard to pinpoint. Obviously, Chinese exports to the United States are down, but at the same time, we're starting to see Chinese exports to other countries go up. So it's not entirely clear that they've had a huge hit. Of course, it has affected them, probably more than it's affected the United States economy, but it's not possible to say that the Chinese economy has been pummeled by any means by the trade war.
Let's talk about this governor's trade trip to the Middle East and to India recently. Should the state of Arkansas be focusing on other areas of the world for exports and foreign direct investment, especially given the troubles that we are seeing with China? Do you think this is a good move?
I think so. I think when you look at the Chinese economy and whether or not they'll continue to grow at the pace that you've seen, so they grew about 6% in the most recent reading, which is the slowest it's been. But there aren't very many other countries around the world that have the sort of manufacturing base that China has had and the ability to have that level of foreign direct investment in other countries to the level that we've seen, for example, around the United States and here in Arkansas, where we've seen several billion-dollar deals from Chinese companies trying to set up manufacturing bases around here in Arkansas and other parts of the United States. So could we replace that level of foreign direct investment from China? There is not another country out there that can provide that level of foreign direct investment, so it's about adding up a bunch of different countries to try to see if we can get there. So India obviously contributes to that. We have a little bit of business from India here in the United States and in Arkansas. UAE could be a new market, but the thing to remember is that when we talk about a global economic slowdown, it is actually truly global. The Chinese economy is slowing, so is the Indian economy, and so is the economy in the United Arab Emirates. So while these new relationships and building new relationships is important to diversify where we might get some foreign direct investment from, it's important to note that we may not actually see those benefits in the short run because all of those economies are slowing as well.
We're coming to the close of baseball season. Let's play Fielder's Choice. We're going to start a new feature called Mervin's Favorite Statistic. You pick something that's of interest to you. What you got?
So since we've been talking about aging workforces, I decided I'd go with the number 1.72. That's the ratio of births to every 1,000 women living in the United States. So that number is often called the replacement rate. That means, how many people it takes, how many births it takes to replace the current population level in the United States as a whole. The actual replacement rate is 2.1. That means we need 2,100 live births for every 1,000 women. We're currently at 1,700 live births for every 1,000 women. So that rate has been dropping. This is the lowest rate we've recorded in a very, very long time. And what this means for the U.S. economy is that the population in the United States is going to continue to age as well. We have fewer new births, which means that we're not supplying the pipeline for new labor force, new participants in the labor force in the future. And this means interesting things for a variety of, so we've had a college education boom. A lot of universities have expanded to accommodate all of the millennials that were going to college. If the birth rate is this low and continues to drop, then you'll suddenly have a little bit of an overcapacity in a lot of these four-year universities, two-year colleges, etc.